The hedge sourceman here is June 27th, 2022. I just wanted to talk a bit about the latest Crescat presentation. Uh, they had a slide where they basically detailed the makeup of their precious metals portfolio, jurisdictional risk or exposure, metal exposure. Uh, and what I really like is that they included some of the names in their list and went over some of the characteristics. I mean, this for a poker player, this is pretty much how I try to think about stories. And they first of all have a column with exposure, net asset value, percentage, basically the size of the holding in their portfolio. Then they have a gold equivalent million ounces target. That's basically blue sky potential, known blue sky potential, because obviously anything can happen, and some of these, at the end of the day, I mean, some of these stories might have, I mean, some of them have multiple projects, etc. But that's like tangible blue sky potential, let's say. And then, according to Quinton Henney, and of course, it's like, I mean, why I watch the Crescat presentations every time, why I put a lot of weight on what Quinton Henney thinks, for example. I mean, this is one of the best geos in the world. His opinion when it comes to geology and potential is worth, I don't know, 1,000,000 times of what my, thought would be, let's say. Uh, so this is basically as good as you can get in terms of having a number. What's the blue sky potential? And the best part, of course, is that they're sharing this, and you don't even have to pay for it. I mean, there's obviously other metals funds, etc., and analysts and newsletter writers and yada yada yada. But most, first of all, are not as good as Quinton Henney when it comes to geology, and most of them are. Well, they don't share it really. I mean, sure, some newsletter writers might share it, but it's like I still consider myself extremely lucky that Quinton went this route and teamed up with Crescat, and they're sharing. Of course, they get exposure. It's a win-win situation in my opinion. Of course, this is good PR for Crescat and their holdings, etc. And I mean, I own a lot of their holdings as well, so I'm certainly not complaining about the names getting more exposure. But stuff like this is like, this shouldn't really be free, if you know what I mean. Because sure, it seems simple, like you put up a number or whatever, but it's not. It's not just anybody who puts up that number. I mean, I could barely come up with a potential blue sky for many cases, and if I did, I would put much more trust in Quinton's estimation of the blue sky. So that I wish they would have the list with the entire sheet up on the side. I don't think they have that, and of course it's not like you can ask for it, because this alone, this slide is like a gold nugget which they're already sharing for free. So I consider myself spoiled just by the fact that they at least showed this number of holdings. But you see, again, let's get back to this. Okay, gold equivalent million ounce target, that's basically tangible blue sky as things stand now. And then they have a probability of delivering the gold target, basically the probability that this blue sky will be reached. And then they have probability adjusted gold ounces. I mean, that's pretty much, I mean, as a poker player, I love this kind of stuff, because this is basically expected value. I mean, if you have a 10 million ounce gold target, if there's a 50% chance, subjectively speaking, of it being reached, then you should treat that on a risk-adjusted basis as you're buying a 5 million ounce gold junior, or a junior that will have 5 million ounces. So then you can compare it to other stories based on the probability adjusted gold ounces, and then compare it obviously to the market cap, etc. Yeah, and then they have probability adjusted gold in ground value. That's obviously a bit more, let's say, iffy, because how profitable would those ounces be, etc. I mean, a 10 million ounce deposit of Fosterville type is obviously a lot more valuable than a low grade 10 million ounce deposit. But at least it, well, it's interesting to see at least. Then they name or list the number of drill rigs. They also include dilution discount, expected profitability premium. I'm not 100% sure what this is. I'm guessing that might have something to do with basically how valuable each ounce would be. Because for Eloro, for example, they have 10%. It's a lower grade. It's not low grade, but lower grade polymetallic system. So you would make it up on scale, whereas 50% is set here for Goliath Resources. That obviously looks like right now what we know about it. That's good widths, high grades. It appears that gravity alone could capture a significant amount of the gold. So that could be a very high margin deposit, a high margin mine, which means that they have a million ounce target here of 5 for Goliath. So that might be worth 8 million ounces equivalent for a lower margin deposit, let's say. So in other words, these 5 million ounces might be the most valuable 5 million ounces in this slide here at least. And then they have appreciation potential. I'm assuming they include warrants, but I'm not 100% sure. I think they cover that actually. So let's just say that includes warrants. Then they have market cap and portfolio contribution potential. I mean, this also brings up a good point. It's like, why am I spread betting here? Why am I spread betting on growth? Because as you can see, I mean, if we only take the Eloro Resources position, theoretically, that alone could bring in 681% return for the portfolio somewhere around 2025. So theoretically, if this Eloro scenario alone happens, that position would basically multi-bag their entire fund alone, assuming they didn't sell anything, etc., etc. So that what kind of, I don't know, pisses me off when you see some stories that doesn't work out too well or are down right now or whatever, and people like lambast, let's say Crescat or Quinton, or I mean, or myself, with some, let's say, sponsor companies or companies that I'm bullish on. The thing is, you should realize that you don't need many to reach their blue sky potential for your portfolio to do well. So again, in this case, they have around, I don't know, I'm assuming they included all their holdings, and they have Eloro at almost 10% of the entire fund. So if that's correct, basically this states that even if Eloro alone would hit 50%, even 50% of the probability adjusted gold target, which is again already de-risked. If there's a 50% chance of that happening, that would have a probability contribution potential of like 340%. So that would almost 4-bag the entire Crescat portfolio, even if all other 90 plays went to zero. Every single one. So think about that. Obviously, everybody would give them crap if 90 picks went to zero, but one large holding alone could basically pull the whole wagon, so to speak. So that's why I'm not too worried right now. I'm very diversified. I'm mostly into high growth plays, and they have peak Lassonde target year here for example, and the Lassonde curve is this one. So after discovery, that's when you're drilling, and it's obviously easier to double the amount of ounces from 1 million to 2 million typically than go from 5 to 10 million. So most of the gains, the value creation curve is obviously steeper early on after discovery, and then it kind of I guess flattens out a bit, and then they go into engineering and actually putting the project into production, etc. So this is where I'm playing most of the time, the exploration phase, and typically post discovery. So from here to hopefully somewhere around here. And it's like when I see people nowadays, they're complaining about the share price. They're looking at some whatever stock. It's like down 5%, up 5%. That's volatility in pennies. And some of these stocks, they're so cheap right now. So it's like, even if they go up 10%, that might be 3 million or something in market cap. Some more, some less. But it's like, okay, 3 million, and people have a attention span or investment horizon, which is basically next week or next month. That's what people are complaining about. That's why people are selling right now, because they fear that somebody else is going to come along tomorrow and sell their stock even more. Because that's what typically everyone is worried about. What are other people gonna do in the short term? Whereas they have a list like, okay, peak Lassonde target year here. Okay, 2025, I think, or no, 23 for Eloro, Pacific Ridge 2024, Snowline 2025, Western Alaska 2025, Core Assets 2025, etc., etc. So what they're saying is basically that these scenarios here, the portfolio contribution potential, the de-risked portfolio contribution potential, will take somewhere around 1 to 3 years. So 1 to 3 years, that's what their cases are about. Because obviously, if one second. This kind of portfolio contribution potential, this can't be reached in the next 2 months. There's no way that Eloro will prove up, 63.75 million ounces of AU equivalent in a month. No, so you have to stick with these high growers until they reach the Lassonde curve and stop growing. Or not growing as much, at least. So that's why I'm just hodling growth. And they basically show you why in this spreadsheet here. Because again, it's very, if Eloro alone needs to be let's say a 10 bagger to put the portfolio at neutral. Okay, how is that gonna become a 10 bagger without you waiting? It's not going to become a 10 bagger tomorrow or next month or in 2 months. No. So these scenarios here assume that you hold through the entire value creation curve of the Lassonde curve, the drilling part of the Lassonde curve. That's why I'm enjoying summer right now, because I know nothing has changed for most of these companies, nothing for the worse. The lure is, that's at all-time high de-risked right now. we have preliminary metallurgical results. They keep on hitting, etc., etc. Pacific Ridge. I mean, I think they've just announced the start of their second drill campaign at Cleule, for example. And Snowline, they're hitting. Western Alaska is gonna drill, and they have a bunch of stuff to drill. Core assets, I'm a little more fussy on the details there, but like SK Mining, and that's gold target of 9 million ounces. I'm assuming that's probably more for the TV Jeff area alone, let's say, because I mean, if they hit at Scarlet Ridge or Vermilion or C10 or the maybe even some of the Excelsior targets aren't even included. So this number I actually expect could change, because if you look at a 6 kilometer trend along TV and Jeff, that alone should have 9 million ounce potential, and there's obviously more targets than that, and we know that, but I mean, I guess that's a bit too early stage, and it might look a bit crazy to put up 30 million ounces target. Goliath Resources, since they hit the extension recently, I mean, this target probably has jumped by quite a bit, so I don't even think some of these numbers are totally up to date as of now, even though, yes, Goliath hitting 1 kilometer step out hole recently to the east, that necessarily say that the system, the potential has jumped by 100%. I'm not sure, but obviously it's a good sign. So maybe a risk adjusted target additional 1 million ounces would be appropriate or whatever. And I mean, then some things I like to think about, for example, is the margin of safety kind of situation. Take Eloro. Yes, that has a huge, especially if I think they include warrants, huge appreciation potential. I think it says something along the lines of 8,600%. I'm not 100% sure, but that's got to include warrants, I think. So it doesn't, it's not the same for me who don't have warrants in Eloro, for example. But anyway, we already know that Eloro has a huge, they don't have it on paper, the resource, but they already have drilled up a lot. So I mean, worst case scenario, they find nothing more, basically. So that's a great position to be in. That's why I really like the risk reward in Eloro. I mean, the jurisdiction is probably the biggest negative. But other than that, I mean, we know they have a huge system already, a huge deposit. They've already drilled that up. So that's already in the potential mine scenario. Whereas Pacific Ridge, I mean, they don't have a mine right now. They haven't drilled up that kind of volume. And also when you consider the fact that, okay, if we take Blue Sky's cases, for example, I mean, if you have a 75 million ounces Blue Sky for Eloro, if you miss that by 50, you probably have a potential mine already. Anyway, because 35 million ounces AU equivalent is a lot, obviously. But it's like, okay, Blackjack Silver here, for example, private company, has a Blue Sky of 4 million ounces AU equivalent. I don't know how they, the AU AG ratio, let's say that's, 50 million ounces of silver, whatever. So I mean, if they miss that Blue Sky by half, that's obviously probably not going to be a mine. But Snowline, if they miss by 50%, then you have 10 million ounces, for example. That's probably going to be a mine. That's almost another Fort Knox. I'm not 100% sure how big Fort Knox is, but there's a few things I think you should think about. It's like, okay, what margin of safety do I have? Can they still miss by 50%? From the risk adjusted even? I mean, they have risk adjusted Snowline by 50% down to 10 million ounces, but if you risk adjusted by 50 again, I mean, that's 5 million ounces. That might actually still be a mine. So those are pretty good odds in that case. I mean, it's not the longest shot, let's say, because then you only need to be, let's say, how about 75%. You can have a 75% miss from Blue Sky and still end up with a potential mine. And also, I mean, what you should be thinking is like, I keep talking about this. Uh, I'm buying I'm buying future value, probability adjusted or weighted future value for prices today. So people can bitch and moan about my junior's down 5% or 10% today or 20% next week or whatever. It's like, yeah, okay, so the junior went down 6 million in market cap, etc. From a 30 million valuation. I mean, some of these stories, it's like, you know, look at the big picture here. Let's say we could time jump all these stories to the peak Lassonde target year here. So do you really, if Snowline, we time jump to 2025, let's say they have 10 million ounces. I don't know exactly the market cap of Snowline right now, but let's say it's, what is it, like 75 million or whatever. Does it really matter if you bought Snowline at 80 million and it went down to 60 million, next month or whatever? No, because if you hold that to 2025, I mean, there's let's say, a reasonable chance that they might have an inferred deposit of 10 million ounces. So that would make 80 million look very low and 60 million look incredibly low, etc., etc. So it's like, if you can start thinking about what's the end game for each story. You think about what you're paying right now for a future that the market is totally oblivious to, because the market doesn't even really reward banked success. I mean, good results, etc., recently doesn't even get priced in. Do you think any of these scenarios, future scenarios, in like 1 to 3 years is priced in? No, of course not. And that's why it's like, you don't need too many of these stories, especially if you have warrants, to actually reach the probability adjusted blue sky scenario. 50% of blue sky in Snowline, for example, 55% of the blue sky of 12 million ounces for Western Alaska, etc. I mean, any of these stores, even if you have, what's the position here in Western Alaska? Okay, 3.54%. Let's say they hit the probability adjusted gold target, they have warrants, etc. But that's an appreciation potential of 7,000% for Crescat, which alone would contribute 233% to the portfolio. So again, in this case, a 3.5% position out of 90 holdings, whatever. If this 3.54% position hit blue sky, that alone would multi-bag the entire Crescat fund. Even if the 90 other names went to absolutely zero, 90 of their companies went bankrupt, Western Alaska alone in this case would multi-bag their portfolio in, let's say, 3 years. And that's a very solid return. Okay, so are there any guarantees that even the probability adjusted gold targets will be hit? Of course not. Do you need it? No. I mean, look at this again. This is from, this is the portfolio contribution potential per play. So it's like some of these, quote, small positions, 3.27% core assets, could deliver 159 or 139 or 159% gain for the Crescat funds if all 90 other plays went to zero. So it's like I keep saying, when I buy a high grower story, I look at it, what is this probably gonna be worth in 2-3 years, which the market is absolutely not pricing in right now. I'm not paying for that future. Nothing about that future is priced in. So that's why you also should get so much more bullish now when you see these juniors sell off, especially if they're cashed up, let's say, if they recently cashed up. Because, I mean, in my mind, it's like, again, take Western Alaska. Okay, I'm paying, I don't know what the market cap for them is like right now, but it's okay. I'm paying 40 million. Let's just assume the theoretical scenarios here are fairly accurate. I'm paying what, 40, 50 million or whatever for a 6.6 million ounce high grade silver deposit. I mean, this is in AU equivalent terms, but like, is that a lot? 6.6 million ounces of, let's call it high grade gold for 40, 50 million. All I have to do is wait 3 years. That's obviously not a lot, because that would be, I don't know how little, like what? I can't even count right now, but let's say, $8 per ounce or whatever. That's extremely cheap. So it's like, this is, right now, there's a buffet out in the junior space, especially when it comes to the high growers, because think about it, like I like to think about it. Why don't I like Barrick and Newmonts? And I know people like right now when the juniors sell off, they're like, trying to flee into the Barricks and the royalty companies and Newmonts or whatever. It's like, sure, they might not go down as much, but I can, with some certainty, I can say that Barrick Gold will not have increased the value of the company by 500% in 2 years. Unless gold, goes to the moon, and that would obviously affect the juniors as well. So it's like, yes, I understand people can't take the pain. They hate seeing the paper losses, and use the most amount of paper losses and the highest degree of paper losses comes in the junior sector. But they're also the ones who have the potential to go up a lot more than the Barricks and the Franco-Nevadas. And the more they sell off, the higher the gap from their, let's say, probability adjusted blue sky scenario up here and their pricing at this period in time. So I mean, if a junior had an expected return of 500% and it goes down 30%, maybe the expected future return gets jacked up to 1200%. Because the geology didn't change because Mr. Market or some dude got scared and so you put in a market sell order. Nothing changed for these companies when you see, flushes in the market. Not geology-wise, sure. I mean, the access to capital, etc., can get affected, especially the longer it, goes on. But I mean, the share price doesn't change geology. What's there is there. What Mother Nature has put there is still there, regardless of what the swings are. So it's like, if you really want to get greedy, you should literally have a probability adjusted blue sky like this for every one of your holding. And you should always, let's say you have a market cap column here for your juniors, and right next to it you have a probability adjusted gold ounces in like 1 to 3 years. And you just, I mean, if that doesn't get you greedy, I don't know what will. Because everybody's looking at the next news release or whatever. But you have to consider the fact that some of these companies will, just from this coming field season alone, could double or triple their value. So let's say an ounce in the ground right now is valued at 10. And sure, or 20. Sure, the sentiment aspect is a major part, because in some point in the future, an ounce in the ground will be valued at $80. So you're going to get let's say a 400% boost from what Mr. Market puts on your ounces. But what if that happens in 2 years and you add 3 times the amount of ounces? Even if the market still values an ounce at $20 per ounce, if you triple the amount of ounces, can't you see that Mr. Market is probably going to have a higher price set on your holding, even in a pretty shitty market? So it's like focus on the company stuff first and foremost. Think about the longer term. Look at longer term horizon than anyone else, because everybody is out there bitching about the daily swings in the share prices of their juniors. They're not looking at this. They're not looking at this. That's what you should be looking at. You should be playing the game that nobody plays, because everybody's playing the short term game, and that's what Mr. Market prices the securities at. So you're just buying something that the market isn't even looking at for the price of Mr. Market's short-term expectations. So let's say, again, why am I pretty chill about things right now? First of all, I'm diversified. Second of all, take a company like Goliath. Okay, if I think they're going to have 5 million ounces in like 2 years, what does it matter if Goliath goes down 10% tomorrow? That's not going to change what the assays show from this field season. It's not going to change anything at all. The opportunity just got better because, let's say in this scenario, I know they're going to have 5 million ounces. So instead of buying 5 million ounces in 2 years for 70 million, I'm buying it for 60 million. I mean, that's great. 5 million ounces of high margin gold in British Columbia underground. That could fetch, hundreds of millions of dollars in value. So when you think about that, stop looking at what your portfolio is going to do tomorrow or next week or next month or even 6 months or whatever. Look at what the companies are going to do, what they probably are going to be worth, and then you have the gold price, helping you out as a bonus. Because I can pretty much assure you that a junior that goes from 0 million ounces to 4 million ounces in 2 years is going to be worth more than at that point in time in 2 years than when it had 0 million ounces on the books. So if you just get the fundamentals somewhat right, and to get that you need to be patient for 1 to 3 years in many of these cases, you're going to get bailed out, almost regardless of how shitty the sentiment will be then, because the sentiment is shitty right now. So if we go from a shitty sentiment to a shitty sentiment period in 2 years, and the companies have increased their value by 300%, you're probably going to be up anyway. And if we go into a high sentiment environment, maybe you can triple that return. So it's like, okay, growth, the value goes up 300%. And then the sentiment adds 300% to that 300%. So, 3 times 3, that's 900%. That's how you make the big bucks. You look at a longer term horizon than the market. You buy when that longer term scenario is as cheap as possible, and then you wait for this to play out. And if you hold, in my opinion, okay, if I just went away on vacation for 2-3 years with my exact portfolio as it is right now, I think I'm going to be up a lot without ever changing a single even doing a single trade, because I think that I just need a few to do very, very well. Like Crescat has shown here. Of course, this is with warrants, but it's like some of these picks alone, if they hit somewhere close around blue sky, they could of course go beyond blue sky as well. But like theoretically, some of these 3 to 5% positions could save the entire Crescat portfolio, even if 90 other holdings went to zero. And again, that cannot happen if you don't give the time for those scenarios to play out. So stop looking at tomorrow, stop looking at next week, start to enjoy the summer, start to position yourself, in my opinion, diversified across the ones that in the next 1 to 3 years has the potential to create the most amount of value in that period of time. That's why I don't like the Barricks. They cannot triple their value. Franco-Nevada probably not going to triple their value. Newmont's not going to triple their value, but any of those companies can run into hurdles. Same with a mature, single asset miner, whatever. Well, they can be very cheap right now. but it's like a lot of mature companies don't have the upside, but they still have a lot of downside risk, which we've seen recently in juniors, shutting down production, uh, and capex blowouts, etc., etc. At least with exploration, the biggest risk is like, are they going to hit or not? Because they're not putting anything into production. And when it comes to production and development of a mine, it's like, I'm no mining engineer. There's a million things I don't even know could go wrong that could go wrong. But I can understand, to me, exploration risk is understandable. I can understand that. I know what I'm getting myself into. Some holes are going to hit, some are going to miss. But they're not building a mine and hiring 100 people and need the supply chains of the world to be top notch, etc. Or you're afraid of a, I don't know, cyanide spill or whatever. So I think this is one of the most valuable slides that they've shown to people, and I wish they would have shared the entire list, because this is like, I pretty much don't. I mean, I can't come up with better estimations than Quinton Henny, not even close. And he could be off by 50% in some cases, and the bets would still be obvious. So if I just had a list of like someone serving me up a blue sky scenario platter and then risk adjust this, then I can just hey, I'll take some of that. Okay, I'll wait 3 years. Good enough. Okay, I can take a vacation for the next 3 years, and then I'll come back, and maybe 5 out of 20 will have done very well, and they would have multi-bagged my entire portfolio basically. So it's like, don't be surprised that a lot of stocks are gonna, don't hit blue sky, but you only need a few to actually hit somewhere along blue sky. But in order to even do that, you need to be able to stick with it for X amount of years. There's a ton of stuff that's pretty basic and very common sense, but almost nobody's prepared to do it. I see people throwing in the towel right now in juniors. Nothing to do with the companies. They're just afraid that someone else will sell them. Do you think they're, matching the current prices to the future scenarios they have? I don't even think they have a future scenario. They just bought it because they expect it to go up tomorrow. And when it doesn't go up tomorrow or the next day or not even within a year, they're like, well, okay, my plan didn't work. Well, that's because they didn't have a plan, or at least not a good plan. So again, it's like, summer is here. It's time to enjoy the summer, and these companies are working, so you don't have to. I mean, the management teams don't do less work when share price is down or whatever, or when the markets are shaky, etc. I mean, you're buying the labor of the management teams of these companies, and they're gonna do their best to have this materialize. Not investing advice, quote. I own a lot of shares of the companies listed here, almost everyone. Some are sponsors as well. These are just my thoughts. Do with them as you like. This is what I think makes the most sense. Highest, in my opinion, expected. Well, the best possible strategy, I think, with the least amount of activity, pretty much. HODL growth. Diversify and HODL growth, and some will do very well, but you have to let them run. Basically, you have to give them the time needed to run really well, and then you can afford a lot of losers on the way. Thanks for listening. Hit the thumbs up if you like my work. Bye.